Tesla's boss, Elon Musk, is about to get a $56 billion payday. That's more money than some small countries make in a year. But while Musk is celebrating, other electric car makers are in big trouble. They're running out of money. Some might even go out of business. How did this happen? Why is one person getting so rich while others are struggling? Let's dive into this electrifying drama and find out. Number 7. Elon Musk's pay package. Let's kick things off with Elon Musk's $56 billion pay package. This pay deal is under scrutiny, with proxy advisor firm Glass Lewis urging Tesla shareholders to reject it. Why? Because it's massive and could hurt smaller shareholders. This comes after a Delaware judge nullified the 2018 pay package, prompting Tesla to seek a revote on June 13th. The concerns are real. If Musk gets this huge stock grant, it could dilute the shares of current Tesla shareholders. Glass Lewis points out that Musk, who already owns about 12.9% of Tesla's value at around $74 billion, doesn't need this extra incentive. If approved, Musk's ownership would jump to 22.4%, further concentrating his control over Tesla. This massive pay package is under scrutiny because Musk, who already owns 12.9% of Tesla's value at about $74 billion, doesn't draw a salary from the company. Critics argue that Musk is already well compensated and that the 2018 grant was unnecessary. The stakes are high, not just for Musk but also for Tesla and its investors. The outcome of this vote will influence Tesla's direction and financial stability at a time when the EV market is already facing significant challenges. Number 6. EV startups in trouble. Now, let's switch gears to the other side of the story. Remember when everyone was excited about new electric car companies like Rivian, Lucid, and Nikola? They were going to be the next big things, just like Tesla. But now they're in deep trouble. These companies, which bet big on electric vehicles, are now facing severe financial issues. Unlike established car makers who can rely on gas and hybrid vehicle sales, startups are all in on EVs, making them vulnerable. Take Rivian, for example. In 2021, people thought it was worth $86 billion, more than Ford. They loved its cool trucks, but now, Rivian is losing money fast. In just 3 months, at the end of 2023, it spent $1.5 billion more than it made. At this rate, it might run out of money soon. Despite Amazon's backing, Rivian is spending way too much on production. Reports suggest it costs them about $200,000 to make one EV. Other startups like Canoo are also in trouble, with cash reserves plummeting from $415 million in 2022 to just $6.8 million last September. Or look at Lucid Motors. They make fancy electric cars called Air, but they're having a hard time making enough cars and running low on cash. They even cut their prices by up to $12,500 to get more people to buy. Number 5. Big car companies hit the brakes. You might think old car companies like Ford, Fisker, GM, and Volkswagen would be doing better. They've been making cars for ages, but switching from gas to electric cars isn't as easy as changing a light bulb. It's more like rebuilding your whole house. Ford's electric car part, called Model E, is losing a ton of money. In 2023, it lost a shocking $4.7 billion. That's like spending your whole piggy bank and then some. Fisker is another name that has had a tough year. The company's stock price dropped from $75 to just 40 cents per share in 1 week in March. Fisker's strategy of outsourcing most of its production hasn't helped. Fisker reported a loss of $463.6 million in the last quarter of last year, despite generating $200 million in revenue. To cut costs, they had to lay off 15% of their workforce. Even with these measures, Fisker's future remains uncertain. This isn't the first time Fisker has been close to bankruptcy, and unless things change drastically, it might not be the last. Volkswagen is also having trouble. They wanted to be as big as Tesla in electric cars, but its ID series cars aren't selling as well as they hoped. Moreover, they are having software problems and trouble making enough cars. Even it has recalled nearly 80,000 of its ID4 electric vehicles in the US. That's a lot. Number 4. Ford's narrow escape from the electrification quagmire. Things haven't been easy for Ford with electric cars. Last year, they lost over $5 billion trying to sell EVs. They even had to stop investing in developing electric car technology, which was going to cost them a whopping $12 billion. Selling electric trucks like the F-150 Lightning turned out to be a big money loser for Ford. They lost at least $36,000 for every single one they sold. Not only that, people weren't buying them as much as Ford expected, so they had to slow down production to try and stop losing so much money. Their other electric car, the Mustang Mach-E, which used to be popular, isn't selling well anymore either. This sales slump, combined with some recent changes in government plans for electric cars, has helped Ford out a bit. Instead of focusing on electric cars right now, they're going to put more effort into hybrid cars, a mix of electric and gasoline, and their regular gasoline-powered cars to ensure they stay profitable. Even Ford dealerships and the company itself are taking a step back from their big electric car plans. They know they need to take a break from selling so many electric cars for now and focus on making money again after all those big losses. Number 3. GM's unexpected pivot to hybrids. Remember how GM was super excited about electric cars and promised to only make those by 2026? Well, things aren't going quite as planned. Even though they poured a lot of money into new electric car tech, they're not selling as many as they hoped. Their goal was to sell 400,000 electric vehicles annually by 2026, but so far, they've only managed a little over 100,000, mostly thanks to the Chevy Bolt, which they don't even make anymore. This isn't making them any money, so they must now slow down on most of their electric car plans. The company plans to introduce hybrid models, recognizing the growing trend towards gas-electric vehicles. This shift is significant. GM dealers are pushing for hybrids, and the company is listening. They've announced plans to roll out a few hybrid models soon, hoping to balance their portfolio and maintain profitability in a challenging market. GM's car dealerships aren't happy about this electric car focus. They'd rather sell gas-electric hybrids, which seem to be more popular right now. GM noticed this trend too, so they're going to release a few new hybrid models soon. Basically, they're hitting the brakes on electric cars for a bit and taking a detour with hybrids. Number 2. EV market slowdown. Electric car sales were zooming ahead really fast, but things are starting to slow down a bit. At first, everyone was super excited, and sales were way up year after year. In early 2022, sales were growing at an amazing 81% compared to the same time last year. But by 2023, that growth had slowed down to 46%. This year, sales are only up 2.6% compared to last year, and they even dropped 15% from the previous quarter. It seems like factories are making electric cars faster than people are buying them. Because of this, car companies are having to lower prices with big discounts to get people to buy their electric cars. This means they might lose money on each car they sell, which isn't a good sign for the industry in the long run. Number 1. New regulations in the EV landscape. Finally, new regulations are adding to the financial struggles of EV makers. In the U.S., there's a big law called the Inflation Reduction Act that offers up to $7,500 in tax credits for people who buy electric cars. Great news, right? Not so fast. These credits come with strict rules about where the battery comes from and where the car is assembled. Many popular models, including Tesla's entire lineup at one point, didn't qualify. This sudden change left car makers scrambling, with some seeing sales dip as price-sensitive buyers looked elsewhere. The EPA has revised its proposal, now aiming for only one-third of new cars to be all-electric by 2032, down from the previous goal of two-thirds. This change allows legacy car makers to continue selling gas-powered vehicles, especially pickup trucks, without major modifications. This shift is a response to the market slowdown and a lifeline for struggling car makers. Significant losses, labor issues, and general instability have prompted the government to ease off on EVs. This gives companies like Ford and GM more time to adapt and continue profiting from their traditional vehicles while waiting for more favorable conditions for full electrification. Many base their entire business models on the assumption that government support would bridge the cost gap with gas cars. Now, with that bridge weakening, they're left exposed, forced to absorb costs they can ill afford. What do you think? Is the electric car industry's financial model due for a recharge? Or will Musk's success eventually lift all boats in this electric ocean? Share your thoughts in the comments below, and don't forget to hit that like and subscribe button for more electrifying insights. Until next time, stay charged.